Most people know why they should contribute to their 401k, but a lot of people have no idea what actually happens after the money goes in. Does it just sit there? Does it automatically get invested? And what are stocks, bonds, and target date funds? And how much risk are you really taking? Hi, I'm Clayton Boone with World Investment Advisors, and that's what we're going to be talking about today. Your 401k is not just a savings account. It's an investment account designed to help you save for retirement over time. So when your money goes into your 401k, it usually gets invested into funds that own things like stocks, bonds, or even a mix of both. So what I'm going to do is I'm going to help you break that down into plain English. A stock represents ownership in a company. When you invest in a stock fund, you're usually buying tiny little pieces of many different companies. You might own a little bit of a large cap US companies, international companies, or even some small companies. And stocks can grow a lot over a long period of time, but they can also move up and down quite a bit in a short term. That up and down movement is called volatility. And volatility is one of the main reasons investing can feel uncomfortable. But for younger savers, volatility is not automatically a bad thing. If you have decades before retirement, you have time to ride through these market ups and downs that you're experiencing. And that time horizon can allow you to take on more investment risk than someone who's retiring, say, next year. Now, let's talk about bonds. A bond is basically a loan. When you invest in a bond fund, you are lending money to companies, governments, or other organizations. In return, they usually pay you interest. Bonds are generally considered more stable than stocks, but they also usually have a lower long-term growth potential. So, in a 401k, stocks are often used for growth, and bonds are often used for stability. Now, that doesn't mean bonds are risk-free. Bond prices can still go up and down, especially when interest rates change. But compared to stocks, bonds are typically used to help smooth out the ride. Now, most 401k plans offer several different investment options. So you might see funds with names like large cap, small cap, international, bond, income, growth, balanced, or even target date. And that could really feel like a foreign language. But one of the most common options is the target date fund. The target date fund is designed to be a simple, all-in-one investment option. The date in the fund name is usually close to the year that you expect to retire. So for example, if you think you may retire around 2060, you might see a 2060 target date fund. The idea is simple. When you are younger and retirement is far away, the fund usually invests more heavily in stocks. And that's what gives your money more opportunity to grow. And as you get closer to retirement, the fund will typically become more conservative by gradually adding more bonds and reducing stock exposure. This automatic shift is called a glide path, and target date funds can be very helpful because they do a lot of investment decision making for you. They're not perfect, and not every target date fund is the same, but they can be a good starting point for many people who want a simple approach. Now, let's talk about risk. And risk is not just the chance that your account goes down. There are different types of risk. There's market risk, which is the risk that your investments lose value when markets decline. There's inflation risk, which is the risk that your money does not grow enough to keep up with rising costs. And there's behavior risk, which is the risk that you make emotional decisions at the wrong time. For many young investors, behavior risk can be one of the biggest ones. When the market drops, it can be really tempting to stop contributing and move everything to cash or simply just make changes out of fear. But your 401k is meant to be a long-term account. So short-term market drops are part of the investing experience. Yes, they are uncomfortable, but they are normal. And if you're contributing every paycheck, market downturns can actually allow you to buy shares at a lower price. That does not mean that you should ignore risk. It just means that risk should be matched with your time horizon and your ability to stay invested. If you're in your 20s or 30s, your time horizon may be 30 or 40 years. So that usually means you can afford to focus more on long-term growth. If you're closer to retirement, however, your time horizon is shorter and stability may become more important. The key is not to pick investments based on what feels good today. The key is to pick investments based on when you need the money and how much risk you can realistically handle. So, what is your 401k actually doing? It is taking the money you contribute and investing it for your future. Some of that money may be invested in stocks for growth. Some of that money may be invested in bonds for stability. And if you use a target date fund, the fund may be adjusting that mix for you over time. Now, the goal is not to try to get rich overnight. The goal is to give your money time to grow, paycheck by paycheck, year after year. So here are a few simple takeaways. First, your 401k is an investment account, not just a savings account. Second, stocks are generally used for long-term growth. Third, bonds are generally used to add stability. Fourth, target date funds can be a simple all-in-one option. And fifth, your investment mix should match your time horizon. The earlier you start, the more powerful time can be. You do not need to know everything about investing to get started, but you do need to understand the basics. Because once you know what your 401k is actually doing, it becomes a lot easier to stay consistent and make smarter decisions along the way. If you want to learn more, visit our SmartMap University, and we have a ton of educational resources on there for you. And as always, make sure your investment choices fit your personal situation, your goals, and your risk tolerance. Thanks for watching. Till next time.